Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's been covering gold and silver markets extensively for well over a decade. He runs the TF Metals Report. He also does the podcast and writes articles for Sprott Money on their website and their YouTube channel. Craig Hemke, thank you for joining me again.
Jason, it's always fun to visit with you. And what fun that we're doing this here late in the day on the 15th of May. As the precious metals are moving higher. I just saw $30 silver go by on the July contract here as trading has resumed. So this is a great time to talk.
And bull markets are always the most fun. So
no doubt about that.
So we're recording this interview on Wednesday, May 15th, 2024. The paper gold price, it almost hit 2,400 again. I mean, the support levels, it seems like the support levels are being bid up well above 2,300. It dipped a little bit, almost to 2,300 in the last 10 days, and then it rallied pretty strongly. Would you say that there's a paradigm shift coming now for physical demand from Asia? Is that starting to overwhelm the paper price gains that we've seen in London on the LBMA, in COMEX in New York and Chicago for the last 15 years? Do you think that there's a paradigm shift underway now?
You know, I was hesitant to think that. I've been watching this breakout that began back on March the 1st, really, when gold closed an all-time weekly high at about whatever that was at night, 20.95, something like that. And then it went $100 the next week. And anyway, everybody knows how this has gone. And, we're all trying to come up with all kinds of reasons as to why this is going on. And the China thing is certainly part of it. I'll tell you one thing, Jason, that has caught my attention, though, as of late, that has really got me thinking, and that is the unchanged quality of the commitment of traders reports over the last 6-8 weeks. Typically, you mentioned how I've been doing this over a decade. It's now 14, almost 15 years, and there's a pattern. There's an ebb and flow to these futures markets. You get this excitement and everybody starts getting long under certain circumstances and up it goes and the speculators rush in and the banks issue the shorts. And pretty soon you get to the point where everyone that's long has bought and open interest has expanded. And then all of a sudden momentum runs out and price tips over and then the speculators dump and the banks cover, and open interest goes back down. And I mean, that's how it works. That's how it's always worked. Strangest thing about the last 5, 6, 8 weeks. Now, is that long enough? It's maybe just anecdotal, but over the last 5, 6, 8 weeks, you've had these run up and then drop and then run up again. And the commitment of traders report balances on average haven't changed. I mean, we're right back as of last week's report in silver, right back to where we were 6 weeks ago, but silver's 10% higher. And so it's, that alone makes me think that maybe there's something else that's driving price instead of the traditional, American speculators and the bullion banks. So we'll see. It's certainly all part of what's been interesting so far this year.
Well, the physical demand numbers, India in the last couple months set a record for all-time high for silver imports. I think it's down a little bit in the last couple weeks, but back in March, they set all-time high. So that was an enormous amount. But I think what's different this time, and you kind of hinted at this, Craig, is the silver inventories. I was speaking to a trader, someone who has a lot of experience on the Shanghai Gold Exchange and Shanghai Futures Exchange trading in China on their metals exchanges. And he basically has been showing all the data that physical silver inventories in the Shanghai Gold Exchange, there's only about 45 days left of physical silver inventories at the current demand levels. And then we're starting to see like the inventories for the London Bullion Metals Exchange, silver inventories are down enormously, COMEX too. So I think that's starting to change with the inventories. But the question then, if the Shanghai Gold Exchange, if a lot of people in China are buying physical silver now at the current demand, where are they going to source the silver from if the LBMA and the COMEX don't have the silver?
That's kind of the conundrum, right? You mentioned Chinese silver demand and Indian silver demand. And this is kind of even at the retail level, because as gold goes up, it's like the old steak to hamburger thing that we talk about with inflation here in the US. As gold goes up, maybe they buy more silver than gold, that sort of thing. And you see that playing out. You see those import numbers of silver into India, and all of that starts to make sense. The other part of it too, Jason, is, silver's kind of caught in between gold and copper in that yeah, maybe it doesn't really have that much monetary or any really monetary use at this point, but it has an investment use. People buy silver as an investment, but it's also kind of closer to copper as an industrial metal and as a great conductor of electricity, all that kind of stuff. And so when you were watching silver, I think everybody right now needs to be keeping an eye on copper too. That's a kind of a current story. Everybody's all excited about, short squeezes and COMEX copper and all that stuff. But copper in London has moved up over $10,000 a ton. It's all-time high prices. Some of these banks are projecting $12,000 a ton. And I'll give you one more thing, Jason, that kind of gets to silver. This potential supply shortage that you mentioned. When I wrote my I do this, every January, I write an annual forecast just for my own purposes, so that when I get to the end of the year and I got a whole bunch of stuff wrong, I can go back and, remember what it was I was thinking that led me, to think that in the first place. But last year, not this year, but last year in January 2023, I had a whole section on copper because as the year began last year, there were big banks, Goldman Sachs being one of them, that said the above ground stocks of copper could be totally depleted by August. Not this year, last year. And I thought, well, God, if copper goes up, then silver's going to go up. That was kind of my thinking. Well, we got to August of last year and, it's still trading at $4 a pound, and not going crazy. It's like, well, I don't know. Maybe I guess they found some copper. Well, maybe they were just early, because now here we are 4 or 5 months into 2024. And now that's all there's a Bloomberg article today about ships maybe being diverted to New York to help companies cover their short position.
There's supply chain problems in the copper market. So it's not just raw copper supply. So it's like a huge supply dislocation too. But what you brought up, I mean, I was speaking with hedge fund managers, and these are not Austrian school libertarian people. These are like generalists, Keynesian types that went to like Harvard Business School or Yale Business School, Ivy League undergrad or top business schools. And they were telling me October, November, December, so 7-8 months ago, that they were short all the commodities. So that's probably why the copper price. So you were talking about, something that was obvious that was going to play out. You didn't know the exact timing on when copper was going to, start to rally. But these hedge fund managers just said, oh, deflation, the economy's weak. I'm shorting copper, I'm shorting oil, I'm shorting gold and silver, I'm shorting all the commodities. I mean, I literally had regular generalist hedge fund managers tell me that one guy was even raising capital in November to start a short commodities hedge fund.
Yeah, I believe it. And again, how about a peak? Ronnie Sturfla is going to come out with his In Gold Retrust in about 2 weeks. And I know he's going to have a bunch of charts in there about long-term historical, ratios of equities to commodities and how we're at long, historical levels ready for a correction. So those people are just walking right into a trap, if you ask me, and getting back to this copper idea, if we're really running out of copper and or have run out, or really close, you'd see it appear in a couple of different ways. I mean, I saw a thing about there's a rate. I can't remember what it's called, a TC rate. I can't remember what TC stands for because I'm an old man. It's late in the day.
Something concentrates. It's part of the supply chain. So
there you go.
There's it's problems in the supply chain.
And it's gone negative, which is really, really rare, meaning that the smelters and the like are paying a premium to get it so that they don't have, so that they make sure they have it, which again is a sign of pretty extreme shortage. This idea, this Bloomberg article today saying that, they might have to divert ships to New York. Didn't have anything to do with New York. I'm looking right now at the COMEX metal warehouse vaults for copper. And they're around the country, Baltimore, El Paso. I mean, there's 6 or 7 of them. The biggest one's in New Orleans. But even if you add it all together, it's 20,000 tons. Okay, that's not very much in the grand scheme of things.
It's weird. It's weird considering the Department of Energy, I think, just added in the last 8 months copper to the strategic metals list. But knowing our government, I don't think they started buying any copper to stockpile. China and India have been front running those announcements the last 3 to 6 months. I don't know if you saw the import data, but China and India, they basically imported just record amounts of copper. China, surprisingly, copper demand in 2023 was positive for copper demand, even though they're having like a housing bubble right now and they may have to start buying the properties. It looks like they may print some yuan up to buy properties.
Right.
But
I mean,
too. Well, I mean, the copper is going to be needed for all those data centers and Bitcoin mining and
Mhm.
electric vehicles. So all those technologies. So any government that has a lot of extra fiat currency lying around, I think 10 years from now, I'd rather have warehouses full of copper than long-term U.S. Treasury bills.
Maybe 1 year from now. No, I hear you. And again, to relate it back to the precious metals, so if copper is running out of physical and they're looking for it in Shanghai and they're talking about trying to dig it up in places like, I don't know, New Orleans and El Paso and Tucson, um, that's going to carry over. That's going to impact silver. It may not be as scarce as copper if that's the case, but there's only 300. If the combined all the different vaults, registered, eligible, all that stuff, COMEX vaults, there's 300 million ounces. But yet, there's 170,000 contracts at 5,000 contracts a piece. So that's like 850 million ounces of exposure of action, so you got 300 million backing 850 million ounces of leverage, straight up, just doing the straight numbers. Not saying that all the registered is going to be for sale or any of that stuff. The eligible just is sitting there. Moral of the story is if you get into a shortage, there's just not that much there. There's not much metal there, especially when it gets to silver and gold because of the leverage system. So copper we used to talk about this with palladium. This whole thing with copper, if it really is becoming somewhat scarce, that's going to bleed over to silver. Copper's not going to 12,000 a ton or beyond, and silver's staying at 29. It's just not. And this is all stuff people should be watching.
So, Craig, the normal games that these exchanges play, whether it's the Shanghai Futures Exchange, I think they raise margin requirements for gold and silver futures contracts. That has not seemed to stop physical demand for the Shanghai Gold Exchange or other demand for coins or bars in mainland China. But the normal games that the exchanges play is they drastically raise the margin requirements, right, to try to get the prices back. Then they say it's like for market stability, but it's really to knock the price back down because a lot of the times they don't have the metal. They change the rules. What they do, cash settlement, isn't that what they normally try to do?
And it worked. They just did it. Back in the middle of April, the Shanghai Exchange, they they put on some term limits, or they lowered the not term limits, position limits. Politics on my brain, and also raised margins. COMEX raised margins ostensibly because of volatility, is what they always say. But here's the interesting thing about that. That cuts both ways. We're sitting here at $30 silver. And that's the highest price we've seen really probably in more than 10 years. So think of every short contract, every forward sale, all of it's underwater. So then if you're leveraged, you're subject to those, and you're short, you're subject to those margin requirements too. And gold's the same way. Here gold's $2,400. Every time it makes an all-time high, every single short ever created is negative and underwater. So if there is enough momentum, if you do that's where these squeezes come from. You start running to the upside, those margin hikes cut both ways. So
it sounds like some hedge funds,
the tables.
Based on my discussion with some of these hedge fund managers, sounds like these hedge funds got caught with that. The banks do stuff like that too. But there's a lot of hedge funds. There was an article, did you see in the last month or so, about too big to fail hedge funds with over leveraged bond trades with like risk parity and the basis trade and stuff. I'm wondering some of those hedge funds were also short the commodities futures.
You bet. And they don't have the, too big to fail, too deep to reach the bottom pockets. Right? That maybe a JP Morgan or an HSBC or a Citi or somebody else has. They're subject to, we just got to raise cash. We got to blow the thing out. I don't know. It'll be interesting to see if we start seeing some of that. In fact, I reference the Commitment of Traders reports, how odd they've been for the last 6 weeks. Well, there's another one coming Friday. And for this current reporting week, you get a survey at the COMEX close every Tuesday. And so the reporting week runs from Wednesday to the following Tuesday, those 5 days. So for over this current reporting week, which ended yesterday, so it's the 8th through the 14th, gold was up over those 5 days, $36, but open interest was down by nearly 7,000 contracts. Typically, that's short covering by the hedge funds.
Yeah,
So,
because doesn't open interest, it tends to rise, right? More people pile into the trade, the higher it goes on a trend,
right,
right? So then open
right,
interest increases. That's normally what happens.
right. So when open interest is going down while price is going up, that's usually a sign of speculator short covering. So when a hedge fund would count as a large speculator. So we'll see. Well, again, it's been so weird for the last 6 weeks. You can't really say anymore that that's how the commitment traders will look when we get it on Friday. But maybe that if it does work out that way, that's the first hint of some of these frenzy years getting caught in a vice.
Also, I think there's a serious supply side problems. You hinted at this with copper. I mean, copper grades are trending permanently
Mm-hmm.
downward. Mine supply for copper and silver in a lot of the main producing countries for silver and for copper over the last like 10, 15 years, whether that's like Chile, Mexico, Peru, Panama. I mean, they've all been in a huge, basically permanent downtrend the last 5 to 7 years. I don't really see that reversing. I think there's a lot of factors. A lot of these countries have become like anti-mining, pro ESG. The permitting process to get permitting approved for a mine is difficult. And then if the metals price goes up, instead of like incentivizing the miner to say, okay, we want you to bring on new mine supply and we're going to collect more royalty taxes with new mine supply, right, at a higher metals price. Instead, the government just panics and tries to raise the royalty tax. The miner says, oh, we're going to cut investment into your country on the mines.
Yeah. Well, and again, if you think of, and I've always thought the silver market was this way in particular. If you think about it being kind of hand to mouth, that the deliveries in London, and so the price is kind of managed to where the orders are and that sort of thing, and that there's just in time delivery almost for a lot of the forward contracts and people that take metal off the exchanges. If that's true, the copper situation as well. I mean, think about, remember the news like 6 months ago about that Cobre Panama mine down in Panama? And it's like the largest Panama mine in the whole copper mine in the whole world. But I don't know. I can't remember what percentage of all of the world's copper produces, but it's a significant, I mean, it's like, I don't know, 2%. I mean, it's a huge amount. And the government of Panama basically shut it down because they decided that they didn't like the terms that the previous government had negotiated with First Quantum, and then ultimately this impacted Franco-Nevada because it was a big part of their royalty stream. Anyway, if you're living hand to mouth, I'm just pulling up the Wikipedia page. This one mine alone produced 1.5% of the global copper in 2023. This one mine, and
Wow.
it's not doing anything right now. It's been offline for at least 6 months. So if you live in hand to mouth already, this could be the thing that push it over the edge.
It's
So
also a
yeah, to
pretty
your point, you're dead right.
It's also a pretty sizable percentage, I think, of Panama's GDP. There's a lot of
Yes.
jobs at that mine too. So
Mm-hmm. This one mine at full capacity, I'm reading this here, could produce 300,000 tons of copper per year, along with the stuff that comes out with it. Okay, that's 1.5% of global copper. Well, 300,000 tons. Didn't I just say the whole COMEX has 200,000 tons or something like that in the vaults? And Bloomberg's writing about how they might have to divert ships to rescue the shorts on COMEX. This could be a real sticky situation here. We may not be done just because price got to $5.13 a pound overnight and then they ripped it lower. This could, and again, most importantly, like I said, silver's got more in common with copper at this point in history than it does with gold. As an industrial metal, as a conductor of electricity. If the copper situation is getting out of hand, that will spill over to silver for all the people that are following the precious metals. That will have an impact.
that's a good point. I mean, copper and silver, both their major growth engines are industrial demand for industrial end users, for all these, for electricity and all these new technologies, solar and electrification, because silver and copper both excel in that.
Absolutely. That's exactly right. And so again, relating this back to metals, that's what's significant here. Because so everybody's sitting there. I get asked this all the time when I'm interviewed. So then I turn around when I do the interview, I ask people the same question. What's going on? Why did gold break out now? Why is silver at 10, 12-year highs?
Well,
And there's a bunch of reasons, but this is definitely one of them.
Well, I think there's two major factors here, and we're starting to see hints of this now with coordinated central banks in the G7. The European Central Bank and Bank of England are already starting to hint that next month they may start to cut rates. I think there's inflation and currency debasement at an even faster rate than the US and a lot of these other countries. So a lot of people are starting to hedge with physical gold and silver, Bitcoin. I think that's why you've seen the price action and the demand hold up for a lot of these things the last six or so months, is because a lot of these central bankers, their government debts are too large. So they can't keep raising interest rates or keep them high because they can't afford the interest payments on the debt. So they're going to let inflation run hot. And that means like kind of, 1920s or 30s policy of global yield, almost full global yield control. They're going to let inflation run hot, the real inflation rate above government bond yields.
No doubt, Jason, you nailed it. And that's exactly where this is ultimately headed. I mean, we got all this stuff we're talking about now, will the Fed cut rates once or twice this year? And what are they going to do about this and that? In the end, here, what I've always called the end of the great Keynesian experiment, the level of debt and the amount of new fiat it takes to service that debt, not only the new stuff, but all the massive pile of existing stuff. The only way you can work that, or at least the only way they'll know how to approach it, is the way they've always done in the past. Pay off yesterday's debt with the cheaper dollars of tomorrow. So they devalue and they have negative real interest rates, all that kind of stuff. But where it ultimately goes, and people are saying, well, they won't do this because it just failed in Japan. Well, it might have failed in Japan, but they haven't even tried it here yet, and it's yield curve control, where the Fed just says, we are the buyer. We will buy all treasuries above whatever, 3% or 4% or whatever they set it at. And man, once that happens, the boat is in the water and ready to get going. That's for sure.
Well, I would say that Japan was successful at doing global yield curve control for 30 years because they were the only country doing it. But now it looks like, Craig, that all these central bankers are trying to copy Japan. And I don't think all these different governments and central banks can get away with doing it, because it's all these workers, if there's global currency debasement intentionally, you're in a race to debase and the workers are going to demand higher wages. It just is like a vicious cycle of like higher import cost for commodities, higher wages. And then that puts pressure on supply chains.
No doubt about it. You absolutely got it perfectly. Your grasp of it is absolutely right on, Jason. And that will be this kind of spiral. Again, that end of the debt-based monetary system experiment where there's no go. And again, this isn't complicated. I mean, this is just math. Somebody tweeted at me this week something about, well, they've been saying it's unsustainable for 40 years. Yeah, well, you might want to learn a little something about exponential mathematics and the power of compounding interest, because we're at that point now where it's moving so quickly that there's really no way back.
Well, also 40 years ago, interest payments on the U.S. national debt were not over $1 trillion, and like one of the 2 or 3 highest line item expenses for the budget.
Yeah, and now we are over $1 trillion. It's higher than defense spending, and again, that's the mathematical certainty of it. You're adding $2 trillion every year. That's only going to get worse at the next economic downtrend, which seems to be at our doorstep. And then interest rates, as they continue to go up, it goes from 1 trillion to 1.2 trillion to 1.5 trillion. And that is why ultimately you got to go back to yield curve control. That's why that eventually gets employed. In Japan, they might have been trying to spark inflation, right? Because their demographics are so bad and everything else that was going on, and continues to this day. The US will be doing it, trying to just kind of keep the plates spinning, figuring, and if I might just kind of go off on a tangent in a second. Powell has told you this, and I'm surprised, not you, Jason, but I mean, I'm surprised how many people missed this, because he said it in March at the FOMC. He said it again the next weekend in an interview with Bloomberg, and he said it again 2 weeks ago at the FOMC. He said, I don't want to be late. The risk here is that, we started hiking too late. Now I don't want to risk cutting too late and send the economy into a tailspin. And he has come right out and said that he's watching the labor market. And if there's any sustained weakness in the labor market, he will put inflation on the back burner and cut rates. And that's why when the bad jobs report for the first time in a while, last Friday. He has said this is what he's going to do. And so the same thing is true about the bigger picture of yield curve control and keeping the plate spinning. Oh yeah, they're fighting for the little guy and they got their dual mandate and all that. That sounds really good when everything's fine. But when push comes to shove, they will do everything they can to keep greasing the gears and spinning the plates and whatever metaphor you want to come up with. The little guy be damned, just to keep the system alive. That's what they'll do.
Well, the Fed is also the buyer. What their main mandate is, the Fed is actually the buyer of last resort of U.S. Treasury. So if there's any problems in liquidity or the banking system or treasuries, or even now municipal bonds, because the Fed had the laws changed and started buying municipal bonds in
Corporate
2020.
bonds, high yield bonds. Remember that?
Oh, they'll change the laws now. It's so terrible. Post 2008, I think basically they just say, "Oh, look, we'll have the lawyers or the lobbyists get the laws changed for us, so we can buy what we want."
Yep. Yeah, and that's where their bread is buttered. It's a point that you and I kind of take for granted, but 99 out of 100 people hear Federal Reserve and they think it's a part of the federal government. Is Federal Express part of the federal government? No. Is your federal credit union? Well, maybe it depends on how you look at it, but you get the point. So the Fed works for the banks. The people that own the Fed, they work for the banks. They're going to work to save the banks first. That's why everything's happened since 2008 and 2009 has been related to that. But people need to be reminded that when push comes to shove, and they got to pick X or Y, but like the meme you see on the internet all the time, you're going to push the button on the left, the button on the right, and the guy's holding his forehead and sweating. They'll push the button that saves the banks and the politicians and the system. Everybody else be damned.
It's not even all the banks that the Fed is going to bail out or save.
True.
I mean, they'll let a lot, hundreds probably, of regional banks fail or bad mergers and acquisitions. Their goal is to make sure that JP Morgan and the 5 or 6 other too big to fail banks and the other large Wall Street investment banks, that they can pick and choose whatever assets they want or get bailouts.
And you touched on it earlier. I mean, the Fed, buyer of last resort, the treasuries. Well, who's the buyer of last resort now? The primary dealer banks. What are there, 15, 17 of them? Those are the ones that will always be bailed out. Those are the ones that they'll feed the lousy banks to them, at a very cheap price. Like, what was the most recent one that went under that JP Morgan bought? First Republic of New York or whatever. I'd lose track.
About a little over a year ago. Yeah, it was First Republic.
Yeah. So that will continue as well. And you get this condensation of power within a smaller and smaller handful of banks that the Fed will keep alive because they're the ones that are, at least under this system, responsible for making a market in the treasury auctions.
I want to transition out of gold miners. I've seen you warn people about buying and holding Barrick Gold and Newmont Mining. Can you talk about some of the problems that these businesses have had?
Barrick forever has disgusted me because for decades, they have been the supplier of the gold, by selling forward all of their production and selling it to the bullion banks and all that stuff. So I've always had a distaste for them. My distaste for Newmont comes from having been a shareholder for a long time and watching it was just 2 years ago. They were $88 a share and they bottomed out a couple of months ago at 30. And if you go back in time and pull up a monthly chart, you'll find that those very same Newmont shares were trading at $30 to $40 20 years ago. So I think the big gold mining business is not one for the investor, maybe for the trader, right? Hey, look, gold's going to rally. I can buy some Newmont, buy some coal, and knock yourself out. But as an investor, I think you're better served finding companies that are growing, that aren't constantly struggling because they're running out because they've done a poor job of investing, like Newmont and Barrick have, of finding new resources or acquiring companies that have good resources. And then they have all of these layers of executive presidents, of vice presidents of this and senior vice presidents of that, and all these committees and all this other crap that comes with, these massive companies. And they're just fat and bloated. And, if your share price is the same now as it was 20 years ago when gold was 6 times less, it was $400 an ounce, maybe there's something wrong with your business plan. So I swear
management,
them off.
business plan and management, because during
Yes.
the bear market, I mean, there was over $70 billion of bad deals written off, and Barrick Gold was responsible for a large chunk of that.
Yes. So if you look at what it does, and I don't run like a mining newsletter, and I've learned a little tiny bit from talking to people like Eric Sprott, about grams per ton over certain meters, and all that. I know just enough to be dangerous, but I don't know all the other stuff. There are some people I know that are really, really smart, that know what all that stuff means, and they can pick good mining companies. And that's what people should do. That you don't just call up your stockbroker and go, I think we should own some gold. The stockbroker scratches his head and thinks, I don't know anything about gold. And he pulls up on his box on his desk and sees that his firm has a hold rating on Newmont, and he goes, well, at least my ass is covered on that one because the firm at least covers it. So hey, why don't we buy you some Newmont? Okay, that's the largest gold miner in the world. Okay. Don't do
Well,
that. If you want to be in the sector, do your homework and find some people to help you, and then you'll be okay.
Well, I think we're starting to see some big name investors, whether that's Michael Burry. Today, his 13F said he was adding in the Sprott Physical Gold Fund. David Einhorn, I think he added to GLD. I don't think he's bought any miners yet. And Stanley Druckenmiller, he's a billionaire. I believe he added to Newmont Mining and Barrick Gold, but that's for liquidity. So I don't think he can go out and buy smaller miners because of how big he is.
Right. Again, here he is. Look, I'm not trying to say that I'm some smarty pants and Stanley Druckenmiller's a dope. Okay, don't get me wrong.
Well,
But
when
come
you're
on, give
when
me a
you're a
break.
billionaire, well, when you're a billionaire though, I mean, if you're Warren Buffett or Stanley Druckenmiller, you can't go buy, a small junior miner or medium-sized one and go buy 20% of the equity without drastically moving the stock price.
No, Eric Sprott does. I don't know. I just think that's just cursory. Well, I just want to have some gold, so I'll buy Newmont and I'll buy the GLD. Well, you and I both know this. You buy the GLD, you own some price exposure, but you're kidding yourself if you think you own gold. The good thing about what Michael Burry did, I saw that tweet today too. He's up to like almost 8% of his portfolio is the PHYS, the Sprott Physical Gold Trust. And at least in that thing, above a certain amount of shares, you can actually get the gold out. So Burry's at least smart enough to buy that instead of the GLD. So to that, I'll give him credit.
I think some of the major problems for Newmont Mining and Barrick Gold is cost control, profit margins. These are just not efficient businesses. So you see more efficiency with some of the other miners, like an Agnico Eagle. They bought better assets. They maintained their profit margins the last 6 or 7 years. If you look at the costs for like Newmont Mining and Barrick Gold, I think they were both producing around $1,000 an ounce only 3 or 4 years ago. And now it's up to around 1,500.
Yeah, and Agnico Eagle is my favorite one. I've owned it mainly. Well, I bought it before they bought Kirkland Lake or merged with Kirkland Lake, but then that, just and again, put it this way: Agnico Eagle today, 3-year high. Okay, Newmont today, 50% below, more than 50% below a 3-year high. So, I mean, this is complicated. Why you want to jack around with those? Well, you can pull up some charts that are really doing quite well. Alamos is one that I now own. I don't know a whole lot about them or their grades or all this other stuff, but the stock has actually been consistently moving higher over the last 3 years. They're doing something right, So I would encourage anybody that, is listening to this. They just saw, hey, gold's back to 2,400, silver's going to 30. I've seen people on Twitter saying the miners are due to really take off and all that stuff. Well, don't just simply buy an ETF or buy Newmont because, like I said, that's the one pick a couple of people that that you can trust. There's friends of ours that run newsletters, things like that. Let them do the work. Let them tell you what are the good ones so that you don't just get stuck with a herd. If you're going to actually profit from taking the risk of owning mining shares, then do some work and get some good ones.
I think it depends on what happens with the gold prices. So I think if gold price stays at like 2,300, say for the next 12, 18, 24 months, or it goes higher and keeps in that uptrend, a rising gold price tide will lift all boats. But to your point, Craig, I think that like you could see, even though like Newmont and Barrick are rising, they could underperform on a percentage basis other better run, more efficient miners.
Right. Exactly right. I threw up my hands back in the middle of February after Newmont's first quarter report. Because I was just like, because that's when I looked all this up and I went, wait a second, now this thing's now down to 32. And I look back and I pulled up a monthly chart and I'm like, it was 32 in 2004. This is ridiculous. And that's what got this whole train rolling. And people said, oh, look at that. He's capitulating. That's a sign. I'm like, I didn't capitulate Jack. I sold my 300 shares of Newmont and I bought Agnico Eagle and I bought Kinross and I bought Wesdome. And they're up considerably more on a percentage basis than stupid Newmont is over the last 3 months.
And how many times did Newmont mention ESG in their quarterly earnings reports?
Yeah, right. Right. And you'll see things on Twitter. We are proud to announce of our sustainable, blah, blah, and such and such. And I'm like, that's why you suck. I mean, I'm not saying you want to, just put cyanide, all over the land that you work on. I mean, you got to be responsible, but it's just layers and layers of management and BS that kills them.
Exactly. They're adding like bureaucracy, all these compliance people that aren't actually helping them find more gold and produce at a lower price. Yeah.
Right. Give me some guys with some axes and a helmet and, traipsing around, Mexico and the Golden Triangle and Nevada and, all these other places. Don't give me a DEI consultant and tell me how great your company is.
So, Craig, silver inventories now, Sprott just put out a chart. I just saw Peter Kruth mention this. Silver inventories are down 450 million ounces lately. Yeah. Record imports from India and other countries. If this trend continues, are the exchanges, are they going to say that like, oh, you're going to have to wait months for delivery? Or do you think that like an industrial end user like Samsung is going to say, we're going to avoid all these metals exchanges and we're just going to go negotiate for a metal directly with a refiner?
Yeah, that last part is something that's always intrigued me. I don't know how much silver, say, for example, Elon Musk's companies use, but I would imagine they use quite a bit. Now, is it enough at the margin that $25 versus $50 silver versus 75 is that big of a deal? You know what I mean? To their car production or whatever. And that I don't know. But I've always wondered if, someday somebody comes along, like you mentioned Samsung, and they say, screw it. We're just going to buy First Majestic and take all the silver, 20 million ounces a year or whatever it is that they make. And we're just going to keep it to ourselves.
China's doing that. Did you see what the deals that like their Zijin Mining and some of their other Chinese mining companies have been doing? They just bought a $300 million mine from Pan American Silver because Pan American needed the cash.
Right. And, and those are always numbers. You get the Silver Institute or the World Gold Council put out their global production numbers. They always count China. When they say 850 million ounces, they're always counting China. When they talk about 2,800 metric tons of gold, they're always counting China, and never an ounce ever leaves. But look at all that supply. Well, really? I think you should probably factor that out. So that's all part of it. And again,
you mean they're counting mine supply in China and they're counting it as available for export onto the global market? Is that what you're saying?
As part of the global mine supply. Yes, that's what they do. They count all of that up as if somehow that's for sale. You could look at a free world supply. You look at recycling supply and say, yeah, okay, that's for sale. But nobody should ever include Chinese mine supply of gold, silver, basically anything as part of the global annual supply. Because if anything, none, if any, ever leaves. And so, and getting back to what I mentioned earlier about copper, I don't know if, again, I'm speculating, years of experience have taught me to think this way, but if the copper shortage that Goldman Sachs was talking about a year and a half ago is now finally upon us, and if the global copper markets and the banks and the big firms that that are responsible for delivering metal at whatever price is discovered through all the different trading, if they're having trouble sourcing metal because they're living hand to mouth, and now all of a sudden, again, 6 months ago, 1.5% of global mine supply just got taken off the market. That seriously, maybe that's what we're feeling now, 6 months later. Is that lack? So that could easily happen to silver too, I guess is what I'm getting at.
Well, the other problem for all these metal supply is how long it takes now to bring a new mine online, especially with interest
Yep.
rates at current levels. So cost of capital for the miner, like the average person is going to say, oh, at these gold prices, they can just flip on a switch and a
Hmm.
new mine supply. It's not like an oil and natural gas well where within a month they could start drilling a lot new supply on land. A mine is way more difficult to bring on new supply. I mean, it could take for some of these countries, it's over a decade to bring on new supply for a
Hmm.
sizable copper mine, over $1 billion in over 10 years of discovery, permitting, building the mine, all that stuff.
Infrastructure, got to get some power back there, all that stuff. No doubt about it. You know, and when mines go offline, they put them on care and maintenance, is the term they always use. It was not like you walk back into the office after COVID and just flip the lights on, everybody sits down and gets back to work. It doesn't work that way. So again, getting back to that Cobre Panama mine as an example, I mean, they shut it down completely. So it's not like if all of a sudden they came to what they thought was a better deal with First Quantum and all that kind of stuff and said, okay, let's turn it back on. It doesn't mean the copper starts flowing tomorrow. And so, yeah, you're right. I mean, you can say we need all these different metals, and I've certainly seen it. Robert Friedland, who started Ivanhoe Mines and is kind of the, I don't even know what to call him.
The Copper
If
King.
the Copper King, sure, let's call him. If Eric Sprott's kind of the gold guy, or whatever, or any of these guys that you want to talk about, Friedland's the copper guy. And if you follow him on Twitter, he'll put two or three things on there a day about the amount of copper that is going to be required over the next 5 or 6 years versus the amount of current supply. And you just like, well, where's it going to come from? And that's all part of the problem. And like I said, even within this current pricing scheme, this kind of fractional derivative, we're going to trade off derivatives, and fractional reserve, I should say, and trade off derivatives and flow the metal here and all, whatever. Even under that, there's just if gold's going to 2,700 or whatever because of the Fed policies, and or copper is going to go to $12,000 a ton, $6 a pound and beyond, it's just not going to leave silver behind. And if silver is going to go, then the mining shares are going to go, because one of the tightest correlations you can find anywhere is silver with the GDX, the big gold miner ETF. Don't ask me why. I'm not going to even, I could try to speculate, but I won't. But it's like a 99% correlation. So if silver goes up, then the mining shares are going to go up. So all of this relates back to something maybe that's actionable for people. If we get copper to go up, continue going up, get gold to keep going up, then eventually there'll be a lot of green on your screen in the mining sector.
Well, also, let me add that the gold miners, when they just announced earnings, they were not beneficiaries of the $2,300 gold price yet. That's not till the Q2 earnings that come out in a couple months. So they're not
Yeah.
going to benefit from 2,300 gold until the second quarter earnings calls, when we're going to start to see that hit. But I would not be surprised, Craig, if we see $3,000 gold in under 2 years. I think there's that many global macro problems. I think that many currencies are being debased with the government debt problems. And it looks like all the governments, they've just, and their central banks have decided, if they start cutting rates, I mean, that looks like global yield curve control, and they're going to intentionally let inflation run hot so they can debase the currency and inflate away the debt in real terms. Not necessarily hyperinflation, but some type of, well, they're going to hope to control the inflation, but let's hope it doesn't get totally out of hand.
Yeah. And, the thing can kind of take on a life of its own outside of the fundamentals, where almost like a bank run in a way. It's like, I got to get some of this before before it goes any higher, before it runs out. It kind of, I guess in a way, like I said, we've been talking about the end of the great Keynesian experiment now for 15 years. And we're obviously, I mean, we're getting closer. Not, I don't know if it's a word is close, but we're getting closer. A part of that is that gold and silver, particularly gold, is your lifeboat in a storm. It always has been for millennia. And ever since 1971, the monetary system has gotten detached from it. Nixon had to close the gold window because there wasn't enough gold at that price, at $35 an ounce, that they could allow conversion. And so there wasn't enough gold then. Now you could say, well, at this price, maybe there is enough gold. Yeah, maybe. But I would also add, what has happened since, in the 50 years since, is a form of alchemy where investors, Stanley Druckenmiller, they want gold, they want exposure to gold. They don't buy actual gold. They've been conned into believing that the GLD is just as good as gold. Or an unallocated account, because the storage fees are less, is better than an allocated account. And so there are it's a fractional reserve system, just like, a bank. And the risk that is inherent to that system is you get to the point where there's not enough physical metal for the immediate delivery. And then, it's revealed that the emperor has no clothes. And you've been sitting in the GLD thinking you own gold, or you've been sitting in an unallocated account at a Canadian bank or a Swiss bank, and you think you can get your hands on it any time. And then you show up to get it one day and they go, sorry. It says here in the fine print, you have to give us 90 days, and 90 days goes by. You don't get it then either. So,
oh, you want cash settlement? Oh, well, if you take all cash, we'll give you a premium. Yeah. That's what I think they did in 2011.
Right. That's how it works. Right. And the paper markets, they'll just one day, they'll just say, okay, we're going to close shop here and cash settle all these things at a certain number. And now we're not going to trade gold futures anymore. I mean, gold futures haven't been around forever. They came into effect about 3 years after Nixon closed the gold window. December 31, 1974 was when COMEX started trading gold and silver futures. Again, as a way of alchemy. It's just alchemy. Here's more gold. Here's some leverage. You don't need the real thing. Here's leverage.
Price
just don't take delivery.
Didn't they start the gold futures contracts on the COMEX? They started that a year before they legalized gold ownership again for Americans, right?
Close. One day before. It became legal for Americans to hold gold again on January 1, 1975. And gold futures began trading on New Year's Eve, 1974. I'm sure those things aren't related, Jason. Come on. You're a conspiracy theorist.
The club, and you're not in it.
Yes. And boy, is that ever going to be true if you're sitting there, with like I said, an unallocated account at one of the mints, or a bullion dealer or anything, and you think you've got gold because they told you. Let's put it this way. I mean, talk about fool me once type of thing. Like, you sign up for an allocated account and they say, well, you're going to pay storage fees, 1% a year. Wow, whatever. Okay, well, I don't want to pay that because gold doesn't pay a dividend. Well, and here's an unallocated account. It's still gold, but the storage fees are, 1/10 of 1%. Shouldn't somebody at that point go, wait a second? How can that be? I have to pay 1% for real gold, and then you're telling me I can also have real gold at 1/10 of 1%. Something smells, and like I said, when it all unravels, people go, yeah, I guess I probably should have noticed something was rotten in Denmark.
This is what happens with a lot of generalist fund managers, like pension fund managers. They get screwed over. They do a lack of due diligence. They don't send people to check on custodial relationships and stuff like that. I mean, you hear these stories all the time. Normally it's pension funds that get screwed over.
Yeah, it gets back to the guys shorting commodities. They're shorting commodities because the dollar's going to go up, right? The Fed's raising rates. Right. And this is a no-brainer.
Deflation. Yeah. No inflation. Yeah. Deflation. Gold is going to crash. I hear that all the time.
Yep. And so you're playing by, what you think the rules are because, you're in the system. And then guess what? That's not really how it works. Got to have some physical metal, and like I said, as the world shifts again, and I'm sure Ronnie will be writing about this, away from financial assets into a new cycle of, more tangible assets, that rising tide is going to lift all the boats too.
And in the 1970s, you also had a relatively strong dollar versus other currencies because Volcker was hiking rates, and the Fed chairman before him, Burns, he did to a certain point, and then Volcker raised them even more. So you had a dollar rally and also the gold price rallying. So it's not like they can't happen together. It's so like the global macro hedge fund guys are like, oh, strong dollar, oh, interest rates relatively high versus other currencies and stuff like that. They're like, oh, that means that gold and other commodities are going to crash. That's like the rationale that they've been thinking. I've been hearing people call this on oil and other commodities too, and they've been wrong for a lot of the other commodities since November, the rally.
And you touched on that earlier, Jason. Again, the dollar index, the dollar is strong because it's being compared to other fiat that are maybe just in that period of time devaluing a little faster. And you mentioned it earlier. You said these central banks will coordinate together to weaken their currencies at about the same rate. Maybe, think of a race where one takes off and somebody catches up, and then the third lane catches up. And then in the end, they all hit this finish line at the same. That's what the dollar index, that's what the dollar versus the yen and the pound and the euro and the, everything else. They're all devaluing to zero. So you could still have this illusion, and that's really what it is. That's what the dollar index is, this illusion that the dollar is strong because they're only comparing it to these other fiat. What you're seeing now, compare dollar to this COMEX futures price of gold at 2,400. That's up 15 some odd percent this year. The dollar is actually weaker versus gold by 15%. But that's not what you hear. Oh, the dollar's strong. The dollar index is up 3%. What are you talking about?
Well, speak to small business owners, speak to someone on Main Street about their purchasing power with their fiat dollars, about like buying food or rent or healthcare insurance, basic consumer necessities, the consumer price index. So like, yeah, the dollar is strong against other currencies. I mean, that's not preventing my bills from going up and other inflation and taxes.
Right on, brother. And that's just it. And again, that's what makes this all so interesting, especially in election year. But all these things combining on top of the Chinese demand, on top of the continuing third year in a row record central bank demand for gold, sure makes it a very interesting time to be a gold analyst. I can tell you that. And it's a very beneficial time to be a gold owner.
Yeah, I agree. And I think going forward, I think starting in Q2, we're going to see some nice earnings beats from some of these gold stocks with the much higher gold price. Now, the question is, can the management teams be disciplined and not do dumb deals like Barrick Gold and Newmont Mining have done over the last 10 or 15 years? Because, I mean, they add enormous ounces of reserves or grow production. And then like all their costs and all their projections don't work out. And then they have problems with the share price and earnings and stuff like that. And the cost rise and the businesses are not run efficiently.
Yeah. And that's what I mean. Do some research, find a company, like a Wesdome comes to mind. Yeah, it's cranking out 100,000 ounces a quarter, and they're projecting to do 120,000 ounces next year, that kind of thing. Price is going up. They've got their costs under control. So their margins are getting better. They're generating cash flow. I mean, that's the kind of thing. That's why, again, I just urge everybody, if you're interested in the sector, if you're interested in miners, if gold goes high enough, they're all going to go up, and I've seen some stuff, from the late 70s when I was in junior high, when gold went from $200 to $900, and there are exploration companies went from 1 to 20, that stuff will happen if gold goes up 4x again in the next couple of years. But in the meantime, if you want to be in the sector, you've got to do some homework. And if you want to hold physical metal, own physical metal. Don't jack around with these ETFs and that kind of stuff. Just get some, trade in your dollars for gold, just the way the central banks are doing, and then stack it in a safe place and know where you can always get your hands on it if you need it.
Yeah, especially with premiums coming down. So there's some deals now at the bullion dealer, and then there's also like the Sprott Physical Gold Trust. They have Sprott Physical Silver Trust. I think there's a platinum and palladium one. The uranium one has been on fire the last couple of years since Sprott created.
Yep. I heard they filed a copper one too. How about that?
I mean, the more commodities ETFs and commodity stock producers ETF Sprott makes, I think it's good because they're giving the retail investor a lot more options than going and buying trying to gamble in the futures market where you can get blown out on one contract because the investment bank saw the order book and how much margin you were using on your trade.
Yeah. And you're reminding me when you're talking, Eric Sprott himself told me when they set up the silver contract, the PSLV, and they were trying to load it with the actual physical silver to deliver to the Royal Canadian Mint where it was held, that they were getting bars that were brand new. And he was like, wow, you'd think there'd be existing bars coming to us. And which again gets to that idea that I have about hand to mouth, immediate delivery of orders,
Well, David Morgan has called it the COMEX a showroom where you see some metal and then you have to wait a long time to have it delivered. So you can order it, but then they make you go through all these extra fees and insurance and delivery costs. And oh, by the way, you have to wait months to have it delivered.
Right. And, and the most recent period of that too was when COVID hit. And, they CME and LBMA blamed it on logistic issues, and not being able to fly planes because everybody was on lockdown, all that kind of stuff. But it was another example of Andrew Maguire they had built for Kinesis, a new storage unit. And they got, as they were filling it, all brand new silver bars too, stamped from a month earlier. And So again, maybe I'm crazy. Maybe that's all anecdotal stuff. Maybe there's plenty of silver laying around. You call up Jeff Christian, he'll tell you there's billions and billions and billions of ounces. I don't believe it. I
Well,
don't
I've
believe it.
heard.
I think the industry lives on just in time order fulfillment, and it's being tested right now with copper, and we'll see how that goes.
I mean, I've also heard tons of anti-gold people say that there's tons of above ground stocks to flow for gold, and that
Right.
tons of gold could easily hit the market if gold prices go to 3,000 or 4,000. I mean, a lot of that physical gold are religious items. A lot of people don't want to part with it. And
Right.
then also, like, if you speak to Swiss refiners, and I'm sure you've spoken to some of them or listened to the interviews, a lot of the Swiss gold refiners have said they've never seen a real 4 nines Chinese kilobar to actually melt down in a
Right.
say, that the only stuff that's exported out of China, a lot of it's fake.
Yep. Just and it's the same way. Again, the metal flows out of London, goes into Switzerland. You can monitor that at Gold Charts or us really almost every month. And then it imports or exports out of London, imports into Switzerland, and then exports out of Switzerland, where it's recast from the 400-ounce London standard to these kilo bars. It's been going on for over a decade, and it's just nonstop, and it's not coming back. It's not coming back. And so, again, it just kind of gets back to what I've said over and over and over. I mean, you don't have to, and nobody should take all of their dollars and put it all in gold or silver or anything for that matter. But boy, if there's ever a time to begin diversifying or continue to diversify out of dollar-based assets into physical metal, boy, this is the time to do it.
I want to thank you so much for your time today, Craig. If my listeners want to check out the TF Metals report or your interviews on Sprott, how do they do so?
Well, the Sprott stuff, I've just been helping them with some audio stuff for the last, I don't know, 6, 7 years. That's at Sprott Money. They're a bullion dealer. And so I write article. The one public article I write every week, they publish for me. My site, TF Metals Report, has been around since 2010. I moved it behind a subscription service in 2013 for two reasons. One, I knew relying on Google and the benevolence of the nice people at Google AdSense was not a reliable business model. So I had to change that. But also, it's amazing if you add just even a 5 cents a day, what you'll do to get rid of trolls. So it made the site troll free. And what's left is a community of people from around the world. We're all kind of trying to help each other through the storm. I analysis every day. So we've been, like yesterday, big part of my podcast yesterday was it looked almost certain that the dollar was going to get ready to plunge below 105, the dollar index. That would imply that the CPI was probably going to come in better, softer than expected. And if the dollar index plunges a point, that's probably going to drive the metals higher. And all of that is exactly what played out today. So I do my analysis. But again, everybody on the site is your friend. And we're all in this together. And for $15 a month, which I think is a pretty nominal fee, you get access to it. So I encourage everybody to check it out because I think it's a pretty special place.